Good evening, everyone. Let's dive into today's market performance. On the US side, the Nasdaq Composite closed strongly, up 2.59% at 26,584.99 points. The S&P 500 advanced 1.79% to 7,736.52, and the Dow Jones Industrial Average also gained 1.71%, reaching 54,085.88. Meanwhile, the A-share market saw even more significant moves, with the Chi-Next index surging a remarkable 5.64%, the Shenzhen Component Index up 3.25%, while the Shanghai Composite showed a more modest gain of 0.33%. Today's market character can be defined as structural divergence with a bullish bias. The capital flow axis was crystal clear, a definite withdrawal from energy commodities, simultaneously pouring into growth-oriented technology stocks. Within A-shares, the strong rally in the Chi-Next and Shenzhen Component indices, contrasted with the subdued performance of the Shanghai Composite, clearly indicates an extreme preference for growth styles among investors, with blue-chip heavyweights being relatively neglected. The U.S. market echoed this trend, as the Nasdaq's outperformance against the S&P and Dow, coupled with continued gains in futures after hours, signaled a cross-market resonance along this very same theme. However, amidst this generally positive sentiment, one cautionary signal demands our attention. The VIX Volatility Index rose counterintuitively by 4.04%, reaching 16.50. This divergence from rising equity indices suggests the presence of some hedging activity or a degree of wavering market expectation in the short term. Nevertheless, the ultimate destination for capital remains clear, predominantly into tech growth stocks, with some defensive allocation to gold, and cash flowing back from commodities. Let's review the global market trajectory. During the Asian session, A-share Chi-Next and Shenzhen Component indices led the charge with significant gains, while the Shanghai Composite remained weaker. This reflected domestic capital's concentrated attack on growth and technology themes, with the divergence between heavyweights and growth reaching extreme levels. This effectively served as the initial trigger for global risk appetite today. The European session, while lacking key data for direct verification, likely saw a stable continuation of risk appetite given the strength observed in the U.S. market later in the day, with no significant selling pressure emerging. Entering the U.S. trading session, high-risk growth assets such as the Nasdaq, up 2.59%, QQQ, up 3.14%, and ARKK, up 3.72%, were among the leaders. Nasdaq futures further rallied by 2.75% after hours, confirming the ongoing global appetite for technology risk. The turning point today arguably occurred after the A-share market opened, with the Chi-Next's rapid ascent. The emotional leaders were A-share Chi-Next growth stocks and US AI computing hardware, while the energy sector and A-share blue-chip heavyweights acted as drags. Comparing with our morning brief, the prediction of U.S. tech growth leading the market was correct, with the Nasdaq's 2.59% gain surpassing the S&P's 1.79% and the Dow's 1.71%. However, our brief incorrectly anticipated A-shares to weaken independently. In reality, A-share growth styles strengthened independently, with the Chi-Next's 5.64% surge vastly exceeding the Shanghai Composite's 0.33%, indicating that the divergence didn't repair, but rather further intensified. The biggest expectation gap today was the sharp 7.32% drop in crude oil prices, which remarkably did not trigger an overall pullback in risk assets. Instead, it seemingly reinforced the easing inflation, lower interest rates, and growth stock benefit narrative. Simultaneously, the Chi-Next single-day surge of 5.64% exceeded typical momentum ranges, and the specific driving events warrant further verification. The market largely ignored potential negatives like the rising VIX and the economic demand concerns that a significant oil price drop might imply, choosing not to price them negatively. From a three-factor linkage perspective, the dollar index edged down 0.14% to 99.88, while offshore yuan appreciated 0.1% to 6.7466. This reflects a weaker dollar and a moderately stronger yuan, which is generally favorable for A-share foreign capital inflows. The US Nasdaq and A-share Chi-Next formed a tech growth dual-engine resonance, but the severe internal disconnect between A-share heavyweights and growth stocks indicates that the A-share market is not broadly strengthening, but rather experiencing localized extreme heat. The 10-year U.S. Treasury yield declined by 1.26% to 4.63%, which, coupled with the crude oil plunge, implies falling market inflation expectations. Both real rates and break-even inflation moved lower, benefiting long-duration growth assets. The relationship among these three factors was largely bullish: rising equities, falling bond yields, rising bond prices, and a weakening dollar all point to a recovery in risk appetite and support for growth stock valuations. Looking ahead to tomorrow, we anticipate the A-share Chi-Next index has a 55% probability of high-level consolidation, with a higher risk of a rally and retreat pattern rather than a continued substantial ascent. Key levels to watch are resistance at 3,550 points and support at 3,400 points. If US AI computing hardware stocks, like Nvidia and QQQ, open higher due to the after-hours futures rally, we must be wary of a high open followed by low-volume consolidation, profit-taking pattern. Regarding currencies and rates, if USD/CNH breaks below 6.73, an accelerated yuan appreciation would benefit A-share foreign inflows. If the 10-year U.S. Treasury yield drops below 4.6%, the growth stock valuation expansion logic is likely to continue. In conclusion, our strategy leans towards controlled long positions, but we strongly advise against chasing highs on assets that have already seen consecutive substantial gains. For tomorrow's market, our overall probability assessment is 40% for an upturn, 35% for consolidation, and 25% for a downturn. Please monitor market dynamics closely and exercise caution in your trading decisions.